Hey, everybody, and thanks so much for joining us. I'm Mike Glenge. I'm a financial advisor with Secure Planning Group. And with us today, we have Scott Waxenbaum with Invesco. And we're here to talk to you about an enhanced tax management strategy. Um, and so we wanted to open up the conversation. And Scott, thanks again for joining us. Wanted to open up the conversation by a brief introduction to Scott and his team, but also talk about the dynamics of the partnership between us as financial advisors and these third-party investment managers and the institutions that are actually um, performing the trades on behalf of our clients. So today we're here to talk to you about a strategy that would be considered a separately managed account. So Scott is part of the team that helps manage separately managed accounts on behalf of clients like ours every day. So we're excited to have Scott with us today to talk about a specific strategy, but more generally speaking, talk about the importance of tax management in general, and then the types of strategies that we're using for clients every day to help drive down those tax costs associated with their portfolios. So again, Scott, thanks for joining us. If you don't mind, could you briefly just talk about your role and how you serve clients?
Yeah, thanks, Mike, and thanks for having me on. So I'm the product manager with Invesco Custom Equity SMAs. So I work closely with our portfolio management team to uh, communicate with clients on the day-to-day activities of our portfolios. So helping clients enter customizations, building out their portfolios for new clients, ongoing reporting to help clients understand what their performance is like and give them updates there and get feedback from clients. So what are new features that they're looking for? What are the use cases that are most important to them, and how can we build those into our platform to help better serve them and to partner with Mike and his team to offer solutions that are best fit for the clients.
Yeah, one thing that's important to touch on before we get into the meat and potatoes, so to speak, is the importance of our independence as a financial advisor and how we serve our end client. So obviously, as a fiduciary, we're here to do what's in your best interest as the end client. And as part of that duty, we have access to any institutional money manager really that's out there. And it's our job to vet each of these individual institutions to understand what they're good at and what role they would potentially play in a client's portfolio. And not all institutions are going to be great at all things, right? And so us as an advisor are matchmaking your situation with the appropriate strategy. And in this particular example, Invesco has a great strategy for tax management purposes, and it's not a one size fits all situation. And that's how we view each client's individual scenario. So us as the advisor are taking all the facts that are unique to your situation, and then we're taking them to partners like Scott and saying, how do we build a custom solution around this client's specific needs? So, kind of opening up the conversation more generally speaking, we have the slide in front of us today because taxes impact all of us, right? So we all have to file taxes on an annual basis. If you have an investment portfolio that is an after-tax investment portfolio, then there are tax costs associated with those investments, right? So when you go to use the money, so when you go to pull money out of the account, when you sell positions, all of these things have tax costs associated with them. Managers like Scott help us drive the tax costs down within the portfolio. And there's different levers that we can pull. So today we wanted to just kind of discuss some of those levers, so to speak. But the graphic we have in front of you is to just show the impact that it can have over time. So, um, it, no matter who you are, what the dollar amount you have invested, you have to consider taxes as part of um, how your portfolio um, performs, how it impacts um, your situation, and then the outcomes that are created. Again, the tax implications of those outcomes. So kind of jumping into the hierarchy of tax management, so to speak, Scott, can you maybe just talk through um, the different types of investment vehicles?
Yeah, sure thing. So, taking a step back, looking at the different options that investors have for their portfolios, that there are a myriad of different vehicles that they can invest in. You know, most commonly, and maybe going furthest back in the timeline, would be portfolios of a handful of individual stocks. And when clients would look to tax loss harvest, which they would approach their advisors about, they could only do that once a year, and would do so on a very limited basis, because the infrastructure was not yet in place to do so at scale and in a cost efficient manner. It was pretty expensive to do the trading and the rebalancing at that time. Taking a step forward, you have the advent of mutual funds, so pooled vehicles that give investors access to a number of benchmarks and investment strategies. Challenge with those is that they often have realized capital gains each year, so an additional tax burden on the clients. Moving forward, the advent of ETFs, so these are similar pooled vehicles, but more tax efficient in that they're able to have rebalances inside of the portfolio and adjusting the holdings without a tax burden on the end client. So improving efficiency there, but still room for further enhancements. And then that brings us to where we are today with SMAs. And these allow the highest level of customization by enabling us to manage portfolios for clients with individual securities that track a benchmark, and we're able to monitor them and trade them on a we can trade them on a daily basis if you know there were tax loss harvesting opportunities to be had. So it's a lot more customized and a lot more efficient in the SMA format, having the opportunity to not only be forced to realize gains, but also the ability to realize tax losses. And then one step further than that, and what we're here to talk some more about today is our enhanced strategy, which takes it one step further in that we introduce a modest amount of leverage, so using margin to extend the exposure of the portfolio and give us more opportunities to harvest tax losses and fine-tune risk in these portfolios. So with that, let me turn it back to Mike, and we'll get into more details on that as we move on.
Yeah, and I appreciate the summary. Maybe drilling into a little bit of finer detail. So, for those who are listening, we have had videos in the past, educational videos that kind of review what a separately managed account is, what direct indexing is. For the purpose of this video, I think it makes sense to maybe drill into direct indexing just like a little bit further. So anybody who's listening and hasn't seen those other videos, to Scott's point, direct indexing allows us to invest in an index like the S&P 500, but the client actually owns individual securities, just like a separately managed account. So the opportunity set for tax loss harvesting is much wider because we're trading those individual securities within the index as opposed to trading in and out of an ETF itself. Um, so like that's the mechanics of direct indexing and how it allows us to take tax loss harvesting a step further. And then Scott was alluding to, again, kind of the purpose of why we're here today is going a step further, right? Like direct indexing has become somewhat mainstream. This margin margin based trading approach as an overlay allows us to enhance the opportunity set even a step further. And I think a good segue prior to getting into like the actual strategy itself would be kind of talking about the types of folks or scenarios that warrant kind of taking this tax management opportunity set a step further. On the screen here, we have examples of a couple use cases. So if you have a concentrated stock portfolio, is one of the most common examples we see. So if whether you picked a few securities or a single stock and it's appreciated over time, or it's something you purchased decades ago, and there wasn't any proactive tax loss harvesting along the way, that's a really common scenario where this approach makes a lot of sense. Another example would be an age direct indexing portfolio. So again, direct indexing has grown in popularity. If you were one of the early adopters, you might have a matured account that might need to take it a step further to be able to perform ongoing tax loss harvesting, or the opportunity for tax loss harvesting efforts has diminished over time. And then lastly, which again, I want to make this more of a call to action to anyone who's listening, is folks who know that they have a liquidity event in the future, whether that's the sale of a property, the sale of a business, an inheritance, or any type of major capital gain event, whether it's shares from a company that you work at as form of compensation, all examples that are very common where if we know of these things on the horizon, we can use a strategy like this to help offset that capital gain event in the future. Um, so I don't mean to steal your thunder there, Scott, but just going through a few of the examples, maybe you can kind of get into the specifics of the strategy and how it takes direct indexing and tax loss harvesting kind of to that next level.
Yeah. Yeah, sure thing. And just to review Mike's points. So these are the most common use cases that we typically help advisors and clients with. Those that have concentrated stock, either they were company employees and got paid in stock, or just savvy investors that bought a company that did really well over the past call it 10, 20 years. And then so we can help those investors de-risk and diversify those stocks in the most tax efficient way. So in most cases, entirely tax neutrally. So clients in a traditional portfolio would usually have to sell those shares, take a tax hit in each year that they do. But with this implementation, we're able to help them glide towards benchmark tracking in a very tax efficient way. Same idea with age direct indexing accounts. Clients may come in with a diversified portfolio, but it's just not that tax efficient anymore. The markets have appreciated, and as they would expect to over the 5-10 year period. But after that time, in a traditional format, there just really aren't any losses to find anymore, since all the positions have grown. And what we're able to do with this strategy, and I'll get into what the structure looks like, is we can restart the tax loss harvesting and improve the tax efficiency for clients with this implementation. And last one, as Mike alluded to, is um, planning for capital events. So investors that are real estate owners, business owners that expect to have a large capital gain, we're able to help them track the market with returns, but at the same time, bank significant tax losses that they can then use to offset their gains in the future. So really powerful from that perspective. Let me get into a little bit of what the structure looks like and how we're running these portfolios. So
If you don't mind, Scott, I just wanted to interject just briefly, real quick, with the example cases. The one thing that I thought of when you were explaining it is commonly when we have a client come to us when they manage their own portfolio or have for an extended period of time, this is the biggest oversight, right? They're so reluctant to give up ownership of the management because they've had a good track record in their mind, but zero tax management has been performed, or very little, right? And so the question we ask to folks is, well, what happens when you go to spend it, right? Like it's okay, you have to pay tax on all those unrealized gains. So again, like we're gonna get into the specifics of the strategy, but again, trying to make it real for you that who this might be a good fit for.
yeah, yeah, thanks, Mike. That's a great point. As portfolios become embedded with appreciation, it looks great on paper, but it can be really challenging to adjust the strategy to either control risk or take liquidity and to spend down those portfolios. So this implementation helps to solve for that. And maybe just a bit of a background on how it's structured. So we call it 130/30, and what that really means is we're for each dollar of equity that we put to work, we're able to borrow an additional 60 cents to gain additional market exposure for both tax purposes as well as risk management. So the 30 of those positions will be on the long side. So, a standard holding, and then the other 30% will be short positions. And I'll get into a little bit of what that means with shorts, but essentially, we like to say that short positions zig when the market zags. And so how those work in, their most basic form is, we're borrowing a stock and then we sell it. And what that sale does is it creates two things. First off is cash, and then the second is negative exposure to that stock. Because to close the position out, you would have to buy the stock back, and the price movements up and down will affect, the will have an inverse relationship to the standard price while the position is short. And why are we doing this, right? The reason we're adding these short positions to the portfolio is as the market trends upward, we're able to realize tax losses on the shorts. So, you may think in years one, two, three, oh, well, some stocks are down, some are up. We can find losses on in just the standard long positions. But by adding shorts, we're able to continue to find losses essentially into perpetuity in years 6, 7, 8 as the portfolio moves on. We can track S&P 500 while clipping tax losses.
Yeah, it's great. And then this is the one thing that kind of trips people up, right? Like to keep it simple, we're just creating additional opportunity for those tax loss harvesting situations, right? Where when the market's going up, the short positions give us the opportunity for tax loss harvesting. When the market's going down, it's the exact opposite, right? Or sorry, I said it backwards, but you get the
Nope,
point is
you were right.
it allows us in all market environments. We don't need the market to correct, or we don't need a declining market to create those opportunities, and we don't need to root for stocks to go down, right?
Yeah, it's really an all-weather implementation because if there is market volatility, we're able to find tax losses on the long side. If the market's chugging along, strong returns, we can find those losses on the short side. So, a best case scenario for investors, really.
Yeah, and the thing that trips people up is like, how could losses be good for my portfolio? And I guess like the concept or the way we try to like explain it is they're essentially paper losses, right? Where we're effectively creating the trades through the margin, or the tickets through the margin trades that effectively create those paper losses in your portfolio while you're still tracking the index.
Yeah, and I think a good way to look at it too, and maybe the most straightforward way to explain what's happening there is you can look at one of our seed accounts, right? So we funded an enhanced SMA with $1 million at the end of 2021. Over the 3 years since then to end of 2024, it tracked the S&P 500 index, so it was up, between 25 to 30% over that time. But throughout those 3 years, we also generated $500,000 of tax losses. So, and those are losses that investors can use outside of the portfolio to help rebalance, realize gains for other parts of their portfolio. They can carry those forward to offset future losses. So there's a lot of flexibility with what investors choose to do while tracking the market and having some tax benefits.
Yeah, so just making sure that the audience understood it. It's over a 3-year period, a $1 million account has racked up $500,000 of unrealized gains. So that's based off of like real performance and real results on the Steed account.
Yeah, unrealized losses, but yeah.
Unrealized. Sorry,
Yeah,
unrealized losses.
yeah. And so it will accumulate unrealized gains as well. But the whole goal is not to realize the gains, right? We want to keep those in the portfolio and let them compound and appreciate over time. And then the losses are what we'll seek to realize, because that has the maximum tax benefits to realize the losses.
Yeah, sorry, I think I tripped up my words while I was looking at my notes.
Yeah, no worries, but I think it's helpful to uh, illuminate that for the end clients as we talk through it. Is the goal really is to avoid realizing any gains, and seek to realize the losses.
Yeah, and to your point, you're essentially like racking them up and you can allocate them as you see fit over time, right? And that's when it comes to the customization components and working with the financial advisor is we're the intermediary between you and Scott's team. Scott is the intermediary between us and the people actually placing the trades. So we're communicating to Scott's team, hey, this client has a liquidity event in 2 years. Their liquidity event will create $400,000 of realized gains. So we need to offset as much of that as possible over the next 2 years. Um, and so if we need to liquidate a portion of the portfolio or sell positions to realize those losses to offset a capital gain event in your life outside of your portfolio, that's the whole purpose of this strategy. And that's why we kind of gave you those examples prior to getting into the specifics of the strategy itself.
Um, yeah, thanks, Mike. So it might be helpful to talk a little bit about, how are we using these shorts as a risk management tool? We've talked about them from a tax perspective, but what about risk? So, especially for concentrated portfolios, think about an investor who bought Apple in the 90s, and it's grown tremendously. But now they're not so sure that, see some negative news about the company, and want to take some chips off the table, but they don't want to pay the tax. We can help them do that, by using these shorts. So we're borrowing against the value of the Apple, and we'll be adding new positions to the account, um, both on the long and short side. But the short specifically, think of them as a way to hedge. So they'll be predominantly in the tech sector. So other tech names, Microsoft, NVIDIA, Apple, well, we're long Apple, so we wouldn't short it. But AMD, but pick a name. We would add that to the portfolio to offset some of that tech exposure, uh, without having to sell the Apple shares up front. And then when we rebalance the portfolio each month, as we realize losses, we can offset one for one the embedded gains in the Apple shares and work those down over time towards benchmark tracking.
Yeah, and I think this is a really important example because most people feel stuck. Like most investors feel stuck in certain stocks because they have so much embedded gains. And that's to your point, like we're able to de-risk your portfolio with this tool because people dismiss the amount of risk that they're taking on with that concentrated stock portfolio. And yeah, in most examples, it's concentrated for a reason because that stock has performed so well. So most people have trouble parting ways. But when you're a 35-year-old investor and you can take on that risk, it makes more sense. But when you're approaching retirement, you're 55 years old, you can't have a single stock portfolio or you can't have a three stock or three position portfolio. You can, but you're going to suffer the consequences when you have market corrections. And so rather than ripping the tax band-aid off, this gives us a tool to de-risk your portfolio while slowly diversifying it over time.
Yeah. Yeah, that's exactly right. And I mean, maybe for that further that point, talking about the Apple example, we have a diagram up on the screen that explains a simplified form of what the trading would look like. So client funds with $1 million of Apple, that has zero cost basis, so it's entirely appreciated. And what are we going to do on day one? We'll borrow 600,000 worth of stocks, both on the long and short side. So um, think adding names on the long side, as well as short, 300K each. And then a month later, we'll look at the movements of all those individual names, and the stocks that are down, we'll close those positions out. We'll sell them, and we can realize the loss. In this case, we can realize 6,000 of losses. And then we can use that against the appreciated Apple to start to work that position down gradually over time. And I say gradually here in that if we're doing this entirely tax neutrally, it's a matter of years. Think 5, 7 years to slowly work out of this position. Now, of course, if clients are interested in speeding up that process, we could accommodate it as well. There's just some taxes that are at play, right? So clients can set a tax budget, say, okay, I'm comfortable realizing 50,000 of gains, 100,000 of gains a year, and we can manage to that. And so we'll incorporate that into the transition glide path as we work from the concentrated stock to the benchmark tracking portfolio.
Yeah. And the word customize is going to keep being repeated here because it's what needs to be driven home the most is this isn't, like I said, a band-aid. It's something where the client, the individual client is setting a budget, a capital gains budget. We're solving for that capital gains budget and it's a moving target over time. And to your point, it could be over 3 calendar years, 5 calendar years. And then in those examples where you have specific liquidity events in the future, again, we're earmarking the strategy towards your specific goals.
That's right. So maybe it'd be helpful just to show another example of what it looks like if clients cash fund one of these portfolios. And this would be in that last scenario we talked about where they're planning for a liquidity event. Yeah, they're looking to sell that real estate, looking to sell that business. And here the clients would fund with cash and and then the portfolio would look very similar to the benchmark on day one. So if you look at the bars up on the screen, the benchmark weights for S&P 500 are the dark blue. The net portfolio weights are the light blue, and the gross portfolio weights are the purple bars. So if you look at a sector like financials, we'll have a couple extra names on the long side, and then some offsetting names, short financials. But on a net basis, the sector exposure is going to look very similar to the benchmark. And that's what enables us to have returns that track tightly to the benchmark as we're realizing these taxable losses each month.
Yeah, and again, it, as we're going through the presentation, it sounds more complicated in nature than it truly is, and it's because most people don't speak this language, right? But it goes back to the importance of why we work with professionals. It's why you have the CFA next to your name and I don't, right? I it's there's a team of folks like Scott managing this every day. And then there's a lot of resources and technology baked into the process, right? And the reason I'm bringing that up is it's something that as the end investor, you can't replicate, right, on your own. There are some turnkey options out there that provide exposure to direct indexing. But going back to the customization component, most of those are going to be cookie cutter or turnkey. So you're not able to solve for these custom objectives. But when you think about the strategy, keeping it simple, you're tracking an index, whatever the underlier is. In this example, the S&P 500, because we're talking about large cap stocks. And you're tracking it to that tracking error. And then all of the proactive trading going on underneath the hood is to create those tax opportunities. So when you look at your performance, if you own the S&P 500 as an ETF, it's going to be very similar, but on an after-tax basis, the return is going to be much more efficient. In terms of looking back through the notes, we went through some of the examples. We talked about the strategy at a high level. Are there any of the talking points you think we may have gone over or looked past?
Yeah, let's jump down to risk management. I think when a lot of clients hear leverage, they hear margin, they think Big Short, GameStop, margin calls, like a lot of alarm bells start ringing for things that can go wrong. And of course we're acutely aware of all of those things, and that's why we take a very conservative approach to managing these portfolios. So the short positions are highly diversified, max of 1% to any stock, but in reality, it's typically 50 to 100 shorts, and these are all large cap names. So S&P 500 companies that are highly liquid, they're not volatile, they don't, move a significant amount in any one day. So that makes borrowing them cheap and affordable to do at these custodians. And then from a leverage perspective, I say 130/30. So that means up to 30% long and 30% short additions. So that's really the max, 60% gross leverage. But we run it anywhere between 40 and 60%. And so this is a very conservative level for this type of portfolio, especially as diversified as it is. And so it can keep clients clear of any sort of trouble, like, a margin call situation. Haven't had any today, even with the recent market volatility we've seen over the past couple of weeks, historic swings in the index. The portfolios track the benchmark tightly and kept their leverage levels in check. So I think that gives investors peace of mind to know that, this is a very straightforward way to track indexes and gain those after-tax advantages.
Right. And to your point, like the purpose for the leverage in this context is really for tax purposes, not exclusively, because you talked about all the risk management capabilities as well. But when you think about the reason why we're applying leverage, it's really to for the tax management. It's not to take on more risk. It's actually to de-risk. So it's a great point to make, and more than anything, we talk about it in all of our other videos. Education is important, right? It's why we're hosting this webinar. It's why it's important to have the conversation with your advisor to talk through all of your questions to make sure that you're not leaving things up for interpretation, because that's how you can get hurt. And then the other thing to note is it's not a good fit for everybody, right? This isn't necessarily something that you need in your portfolio unless you have a need for it, right? So talking through that with a professional is something that's really important. Um, was there any other pieces I know you were bringing up?
Yeah, I mean, maybe last thing we can touch on really briefly is just how often are we making changes to these portfolios? That's something investors want to know. So we're monitoring them daily. We have daily checks to make sure that all of the risk is in line with the benchmark. Constraints at the individual position level, the sector level, to make sure there are no deviations from our expected outcomes. And then in line with the wash sale cadence, so roughly every 31 days, we'll rebalance. So, and when we do those rebalances, we'll seek to realize all the losses possible, but we'll also aim to keep the risk in line. So if there are positions that maybe we have a loss, but it would make the portfolio behave differently than the benchmark, we may not take those that month. So it's a two-pronged approach. Each trade is based on risk and tax, and that's how we predominantly base our management approach.
Yeah, and this goes back to the point earlier where it's the end investor doesn't have the time to do this and or the wherewithal or the professional expertise, right? So it's all the reasons why, going back to the summary point of like working with a team, working with the professional, and then us as the professional, we leverage the true experts who are the ones managing the actual strategy. So, Scott, I appreciate you taking the time to go through the strategy and the mechanics. In summary, bringing it back to kind of the examples we had given, if you have a concentrated stock portfolio, if you have embedded gains in your existing portfolio, even if it is diversified, and or you have a major liquidity event or capital gain event that you know is in the future, all great reasons to schedule some time with us to learn more about this strategy and how it may or may not be a good fit for you. But Scott, I really do appreciate you taking the time to go through it.
Yeah, thanks, Mike, and thanks for everyone for having me on. I would encourage anyone who's interested to reach out. We offer transition analysis. So these are ways to take a look at your current portfolio and see some hypothetical paths on what would the timing and tax implications look like to get to benchmark tracking for my current holdings. And most investors find these really interesting and informative ways to think about how they can start to be more proactive about managing their taxes and controlling some of the risk in their portfolios.
Yeah, and that's a great call to action. That transition analysis is a great tool that we can use to help make it real for you with your specific scenario. Like, hey, this is what it would look like, and here's what the impacts would look like um, in a hypothetical analysis. So, again, Scott, great reminder, and we appreciate you taking the time, and we hope this was helpful for everyone listening. We hope you can join us on the next time, and thanks again.
Thanks so much. Look forward to it.